Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 44, we're going to talk about a little known income tax deduction, which only applies to a small fraction of taxpayers out there, but if the estate tax exclusion is reduced, this may be a deduction that comes back into vogue in the future, and that is the deduction for estate tax on income in respect of a decedent. The best way to think of this would be a deduction for estate tax on something like a retirement account or IRA received by a beneficiary. And then the authorizing code section for this deduction is code section 691C. Now, as always, this presentation is not intended to substitute for legal or tax advice. So, what is the section 691C deduction? It reduces ultimately the income tax liability for a beneficiary of an estate who receives income in respect of a decedent. And it does so by granting a deduction for a portion of the estate tax liability that was generated by that IRD. Now, from an income tax reporting perspective, this deduction is classified as a miscellaneous deduction that's not subject to the 2% of AGI floor or to any alternative minimum tax preference. So, we've discussed IRD in the past. Just as a refresher, it is income that's earned before death but received after death. And as I mentioned, the biggest example of this in terms of dollar value would be a 401k or an IRA or a joint and survivor annuity, where there's a beneficiary who's receiving that income that's tax deferred, and that tax deferred portion cannot be wiped out through the step up in income tax basis because IRD is not eligible for that step up. So potentially without this deduction, the reason we care is because this could generate a double tax. It could generate both an estate tax on the full dollar amount, including the tax deferred value, and an income tax on the tax deferred part received by the beneficiary. So by offsetting the income tax by a deduction for the estate tax, you avoid this double taxation. Now, the way to compute the deduction isn't necessarily clear under the code and regs in terms of how it's applied, but we're going to walk through some examples, and there's some tickets to entry. First, you have to have a state tax liability that's actually generated by that IRD. So if you're a CPA or a preparer of the individual tax return, it's important to have a copy of the estate's 706 so that you know what portion of the estate tax liability might have been generated by that IRD, or at least you can compute it. Now, the corollary to this is that if you have a zero tax estate, as you might have with proper planning at the death of the first spouse to die, there's no deduction available. And similarly, if the IRD qualifies for the estate tax marital deduction, no deduction will be available either, which makes sense. You have to have estate tax generated by that IRD, and that wouldn't happen in the case of a marital deduction asset or a zero tax estate. Then finally, you have to use a calculation to determine the amount of estate tax that is actually generated by the IRD that will go to the taxpayer in question. Now, it's helpful to just determine the entire deduction up front, and the way that it's going to be applied is going to be, up in the air, as we're going to see. But the important thing here is that IRD is treated as being last dollar in the taxable estate when it comes time to computing the deduction. And here's what I mean here. Let's assume we have a taxable estate of 15.2 million, and after the applicable credit, that generates an estate tax liability of 1.448 million. And we're going to assume that part of that 15.2 million is an IRA in the amount of 1.2 million, for which the sole beneficiary is a non-married partner, so that there's no marital deduction. So without including the IRA in the estate tax would have been $968,000. So in that light, we see that the IRA is subtracted as being the last dollars in, and the difference here in estate tax liability is $480,000, which perfectly correlates to 40% of the value of the IRA, because 40% is the highest estate tax rate. So What this $480,000 represents is a lifetime deduction for the partner against the taxation on IRA distributions. Now, as I mentioned, there's little to no guidance on how to apply this. The easiest way to do it would be to take a FIFO approach where you just apply this dollar for dollar to the first IRA distributions that are required to come out. So let's assume that the beneficiary partner of the IRA in the year after the year of the owner's death has to take a required minimum distribution of 100,000. So using this approach, we would apply 100,000 of that 480,000 to completely offset the income tax on that IRA distribution. So there'd be no income tax in this year for the partner, then the partner would have 380,000 of this deduction remaining to use in later years. Now this is the easiest approach, but it exhausts the deduction early. And neither of these are necessarily encouraged or discouraged by the IRS. But what I can see the IRS arguing in the future, maybe, if there's ever guidance, is that maybe this deduction should track proportionately any lifetime distributions from the IRA. So for example, you might use the RMD factor here. So the partner in this case might have to take 1/20th of the IRA as a required minimum distribution for year one based on their life expectancy. And that might be 60,000 here, assuming no IRA growth. And in that case, the deduction would use the same factor. Your deduction would be 1/20th of the 480,000 in estate tax that was generated by that IRA, which would give you a deduction of 24,000 against a $60,000 IRA distribution, leaving 36,000 of that deduction taxable. Then the next year you'd take 1/19th of the IRA is your RMD, and you'd also get 1/19th of the remaining deduction as well, so on and so forth. The risk here is that if the partner does not outlive their actuarial life expectancy, they may end up leaving some of that deduction on the table. So the best and easiest approach is the latter, where we look at this as a FIFO and not a proportionate type of deduction use. But as I mentioned, neither way is blessed or discouraged by the IRS, so it's up to you as to how you want to proceed. Now, in terms of where you report this on the personal 1040, it's on line 16 of Schedule A on other itemized deductions. So note you have to itemize to get this deduction, and you would have to put in a narrative line describing the deduction and the amount. And then on an estate or a trust that's a beneficiary, this is included in line 15A. Now note that if the IRD is taxable to the estate or trust, that's the only time you'd be using this deduction. You can't double dip by using this and also including IRD in the distributable net income deduction. So only if the IRD is not included in your D&I would you apply this deduction on Form 1041, the income tax return for estates or trusts. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thanks again for listening to this episode of the 10th of the Hour, and I look forward to seeing you in the next one.